Hello, good day. Today we are discussing something which is very common, quite simple for some and quite difficult for others. So let's see how we can make this easier for your understanding and exam purposes. So today we are discussing cost of capital. So, before going into this, we need to understand what is the purpose of every organization or a company. So, company exists for one goal only, one main goal only, that is to maximize shareholders' wealth. Okay. So, if I want to maximize shareholders' wealth, how will I know how will I know if the actions I have taken or the projects I'm going to choose are actually going to help in maximization of shareholders wealth? So if I choose project A, if I choose project B, or if I choose one of each or both of them, how would I know that they are contributing to the original goal of maximization of shareholders wealth? If I want to find out if anything is maximizing shareholders' wealth, there is one component that I need to see. Most of the time, people answer that if it's profitable, then we're going to choose that project because that is going to help in maximization of shareholders' wealth. But we cannot compute profit without computation of cost. Until unless we understand what the cost is, we cannot tell if it is actually maximizing shareholders' wealth or not. So, usually there are three main decisions any manager has to make in his professional life or to the company. One is where to invest. Second decision, where this investment is going to come from. So this is financing. And if we don't have any project to invest in, we should give this money back to the original owners. This is known as dividend decision. Okay. Going forward, the simplest thing is if let's suppose I need 1 million to start a new project, and I'm thinking that I can get a loan on this for this. Question is how much this loan is going to cost me, and how would I know if this is an appropriate rate that I should be paying, or bank is not charging me more, or I am not paying more than what I should be paying. So usually the rule is higher the risk, higher the return. What we are looking for is a low rate that is appropriate for loan. Sometimes banks require these as a cost of extending loan to us. In finance, we call them cost of debt, KD. This is usually computed through YTM, which is known as yield to maturity, and we can compute yield to maturity if we have loan time period, that is n number of years, and coupon rate, face value, and last is present value. We can find this as YTM, and YTM is eventually cost of debt. We use, since every debt we have to pay interest. Interest is a tax deductible expense. That means we get to save tax if we have more interest. Therefore, for this reason, the cost of debt is, when taking into account, is after tax, that is KD, cost of debt 1 minus tax. So this is the tax advantage. So whenever we are taking cost of that, it is post tax. Same thing, if I need 1 million and all of this is going to be financed by the owners of the company or the equity shareholders, or they want something in return, and we have to pay something to secure this amount from the owners. So there are three methods in general by which we can find out how much would equity or how much should equity cost us. First method is known as CAPM method. This is known as Capital Asset Pricing Model. It's an old model, 60s model. The formula is cost of equity is equal to risk-free rate plus beta and multiplied by market risk premium. So beta represents systematic risk, RF represents risk-free rate, market risk premium represents return of the market minus risk-free rate. All of these help us find out cost of equity. Another way to find this is through dividend discount model. So for dividend discount model, the cost of equity is D1 divided by price naught plus G. Whereas D1 stands for expected dividend for the next year, P stands for price of the asset right now. For our case, since we are measuring equity, this is price of the share. And G represents the growth. Third method is suggested by the literature. If you don't have numbers for CAPM or DDM, what you can do is for cost of equity, whatever you are paying in cost of debt, add 3 to 5% on top of it, and this will give you a cost of equity. Third is, what if I need 1 million and I was able to secure money from both debt and equity shareholders. So let's just say that 700,000 has been offered by the equity shareholder and 300,000 have been offered by the debt shareholder. Debt shareholders are demanding 10% for their capital to us, whereas owners are demanding 20%. So for 300,000 I am going to pay 10%, that is 30,000. For 700,000 I need to pay 140,000. So in total, if I want to secure this 1 million capital, I will be paying 170,000 as a cost. Hence, cost of this 1 million or cost of this capital is 170,000, or 170,000 divided by 1 million. This sums up to 17%. Another way to look at this is through WACC formula. The formula says that we need to find out weighted average cost of capital. So first we need to find out weights. And what do we mean by weights? So in this terminology, we need 1 million and 300,000 was from debt, 700,000 was from equity. Or I can say 30% of the capital came from debt, whereas 70% of the capital came from equity. 70% we did was 700,000 divided by the total capital requirement, that is 1 million. Second portion is, on 70% of the capital I am paying 20% return, whereas on 30% of the capital I am paying 10% return. So if we sum them up, so this is 3%, this is 14%, and eventually we'll have the same answer we found right here. So weighted average cost of capital is 17%. For weights, we have three methods. The most preferred method is to use market values of debt and equity. In case we don't have it, we can go towards book value. And before book value, there is something that is long-term debt to equity ratio, debt to capital ratio. So based on this, so there are multiple ways how you can measure weights, but weighted average cost of capital tells us if we have a mix of both debt and equity in our capital structure being used to fund or finance your capital projects. Thank you very much. We'll be seeing you in our next class. So this is summary of cost of capital, and going forward we'll be doing some practice questions.